Hey, good morning, good afternoon, good evening, everybody. Thank you so much for joining us today. Uh, my name is Drake Breeding. I'm Protocol Opportunities Lead here at Figment. Today, we are joined by the Steakhouse Financial team to discuss an awesome new report they put together called Restaking in the Price of Trust. Before we get into it, just wanted to throw out a quick disclosure that views here are presented as Steakhouse Financial's opinions, not necessarily the views of Figment Inc., not financial advice, etc. As a reminder for everyone joining us on the webinar, if you have any questions, please feel free to throw them in the chat, the Q&A function. We'll try to get to as many as we can. Yeah, that being said, would love to introduce our panelists. As I said, I'm joined by three of the chefs over from Steakhouse Financial and another figmate of mine. Chef Adrian, you want to kick it off with a brief introduction?
Yeah, gladly. Did you call your colleague a figmate?
I did, yes.
Okay.
Not my term.
All right. That's quite funny. So, hi all, and thanks for joining. We're going to go over some slides that will summarize some of the key points that we touch upon in our report. The context for this report emerging is that we are a boutique consulting firm that specializes in building open and transparent finance by working with open source protocols. And the relevant experience here is the work that we do as the finance workstream lead for Lido DAO. And in that context, we wanted to, the three of us will take a second to introduce ourselves, but we come from sort of TradFi backgrounds, and we wanted to understand restaking a little bit deeper. So we tried to do that and make a mental framework for someone with this mindset in a systematic and very simple way. As for myself, I have an engineering background and a TradFi career, and I'm a co-founder and chef at Steakhouse.
Hey guys, I'm Equanimity, also known as Sonia by my government name. I have a financial mathematics background. I also have a TradFi background, was a fundamental investor, a value investor, managing money on behalf of institutional clients.
Hey y'all, I'm Danny, otherwise known as McNutt. My background is accounting and economics, and I too had a TradFi background, running credit funds, and then most recently also infrastructure. So good to be here. Nice to meet you all.
I'll just hop in real quick. My name is Ben. I am a figmate of Drake's. I'm a protocol specialist covering the Ethereum ecosystem. So, covering things that are happening on the base layer from the stakers or staking service providers perspective, but not just the base layer. So it's not just about, for instance, Pector coming up, but also everything built on top. So, you think about things like MEV, DVT, and of course, eigenlayer and restaking, all of that kind of falls into my wheelhouse. And just want to give a little more love to the Steakhouse team on this report. It's very timely, super important. I think it really helps frame the way to think about AVSs. So for anyone on the call that has not read it, really encourage you to do that. I imagine everyone has, but on the off chance you haven't, I know you're going to walk through it, but really helpful report, especially now where people are looking for information, especially about rewards, how to think about things, how to frame things. So really emphasize folks should read the report in addition to being on this webinar.
Yeah, totally agree with that. I think if you're involved in crypto world right now, we all hear a lot about restaking, AVSs, LRTs, eigenlayer, this whole kind of new ecosystem going on. But with the background of the sort of TradFi, getting applied here, I think it's really interesting to take a look at how economics work from a more kind of fundamental investment perspective. So super great report. Very excited to be joined here by the Steakhouse folks.
Yeah, cool. So the three of us will take turns just covering the different aspects of the paper. But I will start with our objectives. So basically, big innovations come with hype cycles in crypto, and restaking and LRTs brought a lot of excitement to the market. But we wanted to understand it, from a fundamental perspective. And when we wrote our paper in April, the idea was to build intuition around restaking from an economic perspective with the hope of reaching eventually institutional participants. So thank you so much for hosting us today, Figmates. So our objectives were, just answering simple questions. What are crypto economic networks? Staking, restaking. How should we think about the unit economics of restaking? And what are the market expectations currently for restaking? So feel free to refer to the actual paper afterwards, which is shown below in the links. So next slide. So here, I presume we all know what Ethereum is. It's a public asset ledger. Simply, it operates as a two-sided marketplace that connects decentralized applications and their users on one side with validators that help process the transactions on the other. And what really sets Ethereum apart from TradFi infrastructure is the idea of decentralized trust. So trust in the corporate world today is generally built up through reputation and law enforcement. We trust our banks and their, closed ledger systems because they're regulated and have a reputation to protect. But, users of Ethereum can trust a network because validators have put up collateral, in this instance, in increments of 32 ETH. And this collateral is pledged as commitment to honest and diligent validation. And this stake of pledged Ether is basically what we call crypto economic security of Ethereum. So ETH holders who choose to stake their ETH and contribute to Ethereum's crypto economic security, of course, get compensated for the additional risk that they've taken. And EigenLayer has come up with the term AVS. You may have heard of actively validated services. AVSs are essentially any decentralized networks that operate with a validator set and crypto economic incentives. And our first intuition was, wow, Ethereum is one example of AVS. We know Ethereum very well. It's been built up over the last 10 or so years. So why don't we start with the learning points from Ethereum to start to build a building block, the building blocks of thinking about restaking and AVSs. So that's kind of where we started. If you get to page 6. So yeah, since Ethereum is the most well-known example of an AVS, from an investor's point of view, we could break down the Ether total return into the sum of price return and what we called work yield. So in TradFi, where the total return of a stock, for instance, is a sum of price return and dividend yield is paid out equally to all capital providers. In the crypto economic networks, the work yield differs based on what kind of holder you are. So if you are a non-staker, the Ethereum issuance to validators as a staking reward will dilute your returns, so the work yield will be negative. In contrast, if you're a staker, your work yield will be positive in the form of staking rewards. So total return has positive or negative work yield based on whether you're staking or not staking into the network. Of course, the price return can be broken down into 3 further components. This is quite a common decomposition in value investing. So price return is the product of earnings growth, the multiple growth, which is often expressed in TradFi as PE multiple, and the change in supply or shares outstanding. So in this case, how much Ethereum is being issued to the stakers or being burned by the gas fees. So next slide. This chart actually shows the decomposition of price return of Ethereum over time. So you can see that in the earlier stages of Ethereum's existence, most of the price return was driven by the market perception or multiples growth. So, a new network comes across the investors' minds and, they're very excited about things. And, of course, the natural exuberance pushes up multiples. But as the world decides to really look into how this functions, how this new network is functioning, then you start to look at the earnings growth. And you can see in the last 18 months, the price return has really been a function of earnings growth for Ethereum, or gas fees growth. So this indicates to us that the initial hype around restaking will also be driven by speculation, but in the end, it will be the earnings of these new networks called ABSs that will drive the investment outcomes.
Great graph. Real quick, if I could interrupt, Ben, would love to just, would you mind giving the audience a refresher on kind of how we think about staking rewards on Ethereum? I know we kind of divide them into consensus and execution. What kind of drives the differences in reward rates on that?
Yeah, sure. So real quick on Ethereum, and I think this was reasonably well covered in a couple slides ago, but just to reiterate maybe, when you think about Ethereum, there are, as you mentioned, Drake, there are consensus layer rewards, execution layer rewards. The way I look at it really, consensus layer rewards, it refers to the issuance from Ethereum to validators, essentially to run the network. So you can think of Ethereum as having a budget to help secure the network. Essentially the protocol, Ethereum, pays out these consensus layer rewards to secure the network. The execution layer rewards are not related to the protocol itself, but rather to users. So when a user wants to get something done on Ethereum, they pay fees. And part of it is a base fee. There's also a tip or priority fee, and that helps users to potentially expedite their transactions. In other words, get them included in the block sooner. And so validators receive both the consensus layer rewards for testing, proposing, and potentially sync committees. And when they're proposing a block, they're also entitled to these execution layer rewards, which are related to tips and MEV and things like that. So yeah, just from a high level, that's what we're talking about when we look at rewards on Ethereum.
Cool, thank you. Yeah, so this slide actually shows other L1 networks that have bootstrapped their own crypto economic security through launching their own tokens. So when we look at the net issuance, which is essentially how much the network is paying the decentralized set of validators for providing the trust, the figure we can see is massive in multiple billions. That's the last column of net issuance. And the observation here is that basically creating a new crypto economic network from scratch can be a very expensive task because validators need to be incentivized over time to join and continue validating for a new network.
If I could just make a real quick point here, one of the things I just emphasized for folks, not super important to the discussion, but one of the things on the eigenlayer side about restaking is this idea of stretching stake, and we might get there in a little bit, but I just want folks to take a quick look at the staking ratio column, and what pops out to me is just the range of stake, and to me the fundamental question of how much stake do you need to secure a protocol, and you just get a sense of just how much of a range there is there. Anyway, just wanted to highlight that for folks just so you can get a sense. Different networks obviously have different staking ratios, and what is the right amount of stake you need to secure your network.
Yeah, fantastic point. When you see new layer ones launching, the staking participation rate tends to be super high on the early stages of it. So cool to see that it's lower on ETH. Go ahead, Chef, please.
So next slide, Adrian, thanks. Yeah, so we've seen, bootstrapping a decentralized set of validators for a new network is very financially costly, but it can also be operationally challenging. And this is because left to own devices, the power law and economies of scale that are present in industries force the outcomes towards centralization. And centralized providers with larger stake end up generating more operating leverage over its competitors. And here, the graph on the left shows the makeup of ETH staking by the node operators. And I'm going to pick up on Coinbase here for a second because they have nearly 15% share of Ethereum stake, and this has been growing rather rapidly. And there's Lido shown in the blue with just under 30% share. And decentralized solutions such as Lido that algorithmically distribute stake to its underlying operators like Figment are crucial for keeping decentralized trust of for instance, Ethereum or other AVSs very resilient. So we note that Lido today has over 100 underlying node operators and choosing to stake with decentralized solutions will preserve the value of an AVS or a decentralized network, whose number one proposition relative to, like TradFi is this notion of decentralized trust. So yeah, so far we learned, that Ethereum is an AVS. Staking Ethereum provides positive returns above and beyond just the price returns for stakers. Bootstrapping any decentralized validator set is not only financially, but also operationally expensive. And we've been at this for 10 years. So, why not use this wonderful asset called Ether to try and help erect new AVSs? And this is kind of the core idea behind restaking. So yeah, Adrian can walk you through kind of the specifics and the unit economics of restaking.
Cool. Thank you, Chef. So to go into the topic on restaking, one intuition that we developed early on is that restaking looks like, from a business or unit economics perspective, like a buy versus build consideration, where on the build side, you have the alternative that some of the Cosmos networks that we showed earlier have chosen, where they do something similar. You could describe it to something that looks a little bit like CapEx. In other words, a very large upfront investment that's required to build a network from scratch. In this case, incentivize the validators to join. The advantages of this is that at the end, when this process is successful, you end up with a sovereign network that is decentralized. And it's important to note that there is something of a sort of chicken and egg problem here, because users value decentralized networks for the purpose of its ability, or rather inability, to censor some of these transactions. There are other benefits, of course, like settlement speed and transaction latency and so forth, but fundamentally a decentralized blockchain carries value precisely because of its censorship resistance that enables so many other applications on top. So the prospect of being able to end up with a sovereign network once this bootstrapping process is completed is very attractive, which is why a lot of networks choose to make this investment. The downside is obviously that the bootstrapping can be very expensive, and it's not guaranteed to actually fix this cold start problem. So the alternative that restaking proposes is something similar to renting versus buying. With renting, the AVS that rents the network, in a sense, inherits security from the underlying network. In the case of restaking on Ethereum, it inherits very strong security. So it's a very flexible and appealing proposition to eliminate this CapEx problem for networks and allowing them to focus on developing a network that's actually useful without having to worry about also having to bootstrap a group of decentralized validators. The downside is a strong word. Maybe the trade-offs that this introduces is that in the so-called capital structure of this network, you introduce a new user, a new segment, a new actor. And the other challenge is that for an early stage network that is just starting up, these early stage unit economics may still be unattractive to break the cold start problem without relying on token inflation. So token inflation was the big problem, the big expense that build was supposed to fix. And there is a trade-off where it may still be necessary to bootstrap some of this early security for new AVSs or networks.
And just maybe one thing to add, I think also important for folks to bear in mind that, nothing's set in stone. Like, you could start by renting economic security, and then as your AVS develops, there's always the potential to create, a token and then use a dual staking model or something like that. So it can be fluid, in other words.
Indeed. So the intuition when we refer to capital structure, this analogy is imperfect. So we're not trying to imply that Ethereum or AVSs are somehow shadow businesses or the like, but balance sheets, we think in balance sheets, we come from TradFi, and we think that they provide a useful framework for identifying who the different actors are and what their assets are doing on different parts of a network. And in the parallel that we make, you have a company capital structure with obviously assets on one side, liabilities and equity on the other. With Ethereum, you have a relatively simple structure where we divide it into preferred holders and ordinary holders in relation to their seniority of claim to the work yield. So ordinary holders have face a dilutive effect of the work yield, while preferred holders receive this work yield in return for their capital. And you can extend this framework with AVSs by considering the providers of restaked capital as a sort of senior layer, as a senior quote unquote debt. In other words, the analogy is similar to I lend you capital in order to secure your AVS, and in return I get an expectation of a fixed fee. And that security can be capitalized on the asset side because that security has value for that network. It's an intangible asset that adds value to the users. So as we've alluded in several places, the landscape of restaked networks is obviously still very emergent, and it's in very early stages of development. In our report, we propose a taxonomy that ranks AVSs or networks on their proximity to a blockchain. So you have blockchain utilities with services like attestations, pre-confirmations, block proposing, interoperability. And then you can move further out with roll-up utilities for layer 2s, things that are useful for, that could be useful for Optimism, for Arbitrum, or new layer 2s that are just starting. And then you have application utilities that are even further out, things like oracles, MPC networks, and others. We have a snapshot of what this landscape looked like back in April. This has evolved since then, and is likely going to evolve even more in the next 12 months, with many more AVSs starting up and using this ability to sort of short circuit the build decision to build their products quicker and bring them to market faster.
Yeah, great point. Just I really think that an AVS can and will be everything. It's a huge spectrum of possibilities about the kind of applications you can build with built-in shared security. And I'm still thinking about Sonia's analogy that ETH is the first AVS. We think about that for a bit.
Yes. On unit economics, so on the topic of unit economics, the way that we propose this framework, we've modified it slightly since the report, but the basic point still applies, where the way we think about the unit economics is basically the ability for a network to deliver a restaking fee that's in line with the expectations of the providers of restaked capital. If you go from left to right on this graph, we start from native ETH, and we go from staking with Lido staked ETH, our personal favorite way to stake. You have like restaking in non-volatile token rewards with ETH and USDT, and then you move further out along that line with different sources of return, and those sources of return can be ranked in terms of dilutive impact on the holder. Then you have on the first row the price return, and then you have the execution and consensus layer rewards, which the Figmates discussed earlier. And as you go up, you notice that the variability of the returns starts to change. So with more complexity, you have more variability in the sources of returns, all the way up to the maximum variability, which is basically points or tokens or token rewards as a reward for committing early to some of these providers for restaking. And we make a distinction between non-volatile token rewards and volatile token rewards. We make the assumption that restakers will prefer ETH or USDC fees as opposed to receiving native tokens from an AVS, which we would consider volatile tokens. And we expect that providers of restake capital would likely sell. And so in summary, what we believe is that networks should be evaluated like infrastructure businesses, essentially, in relation to their ability to sustainably maintain enough security to function safely. So the purpose of restaking at all is to deliver some level of security to an AVS or a network. However, if a network raises too much restaked capital for its security needs, it won't be able to deliver an attractive percentage return in non-volatile tokens for its level of cash earnings. In other words, we would consider it to be over-secured. And on the other hand, if a network raises too little restaked capital in order to maintain a competitive APR, it may compromise the integrity of its operation and under-secure the validation of its activity. So we would look at cash earnings of a network. We proposed in our report this ratio, restaking operating affordability ratio, or ROAR, as an analogy to debt service coverage ratio, where we look at the cash earnings in terms of profitability, efficiency, and TVL. And we look at the expectation for restaking fees that are delivered by the providers of restake capital. And so what you can do is basically work backwards from an illustrative network balance sheet. If you start from, say, a target level of TVL, you can then show what the minimum cash earnings would have to be in order to deliver some percentage of required return to restakers. So in our framework, we have a sustainable AVS balance sheet where we have the security value, the amount of restaked ETH, and the book value in the native token. And in turn, you have the backwards implied necessary minimum cash earnings to deliver 5, 10, 15, 20, 25%, and so forth. And so a restake network can be basically evaluated on what its minimum cash earnings need to be in order to deliver a specific percentage APR return. Now, to note, these are very high percentage numbers, and the levels of cash earnings that these are implied are on the magnitude of the whole of Ethereum. So these are very, very large numbers. And the other thing to note is that obviously ROAR declines with increasing expectation for restaking yield because there's less ability for cash earnings to cover the restaking fees. And so this raises the question, which is, so a lot of this is still very hypothetical, right? Like AVSs are only just starting to come online. None of them have any sustainable business model in motion yet, though many of them have plans for it, which means that we have the challenge of not being able to evaluate what the market potential for actual restaking fees is. So we have to estimate it. And the insight that we came to in our report was to look at the economics of rollups, because we consider rollups as a type of actively validated service or restake network that could benefit from some of these functionalities to sort of rent the security instead of building up their own network of validators. And so we tried to triangulate what a reasonable sounding range of restaked fee APR could look like based on economic activity on layer 2s. On the right-hand side, you have a graph for layer 2 transaction fees, and on the bottom hand, you have the sequencer profits. And if you took basically 100% of the transaction fees and you delivered them to the restakers, which we can consider the 5.3 million ETH that are in EigenLayer at the moment, it would approximately equal 4%. This is if 100% of all the L2 transaction fees went to ETH, which is very unlikely. On the other hand, if you took a reasonable amount of sequencer profits, let's call it 20%, that could be saved or amortized or similar, and you delivered that to the restakers, we calculated an upper bound of about 0.75%. So obviously this is what a snapshot of the market looks like today, because this can change if, for example, the amount of restaked ETH declines, or if there's some new market opportunity unlock with a restake network that delivers an enormous amount of economic activity that can make up for it. And when we try and contrast it with the reality on the market, it's very difficult, obviously, because it's still very early stage and very sort of pre-alpha. And the only other triangulation point that we have are EigenLayer points. Now the situation has changed slightly with the release of the token. At the time, the point was the only promise. But even now, the token doesn't trade, so it's very difficult to ascribe a market value to it. What we did is we looked at tokenized EigenLayer points, the token called KEP, and we backwards implied what the expectation from the market was on the total return from restake capital based on the price of KEP tokens. And it approximately landed at between 30 to 40% APR. At this stage of expense, it really begs the question of why restake at all and not just bootstrap a sovereign L1. If restaking is going to be that expensive for a network in the 30 to 40% range, it reaches the threshold where you might make the argument that it's not worth restaking at all. You may as well just, inflate the token and buy your validators. But we expect it to be much lower. And as a contrast, we have the different levels of staking APR, consensus and execution layer rewards. And then on top in red, we've layered on I think we took 100% of layer 2 profits just to show where that lands on on the graph. So we've talked now a little bit about the unit economics of restaking and frameworks that could be useful in the future for evaluating what AVSs to restake to, for example, or how to evaluate the sustainability of business models. Now I'm going to hand over to my colleague, Chef McNutt, to discuss a little bit about what implementations on the market look like today and touch on maybe a little bit more about the risks.
Yeah, so if it wasn't clear that there's so much complexity already at like the unit economics level, it's only compounded by like the practical realities of actually participating. If you think about like the complexity of like just staking alone, and that's why we have like wonderful people like the Figmates helping us figure these things out. How it's being implemented in the restaking market is extremely complex. And so this beautiful graphic on the right kind of gives you like a sense of the layers on top of just like simply staking. And so the premise of it all is you end up with this curation problem. It's not like staking where you have a single network of rewards of consensus and execution, which may be even at that level opaque for some of you. We now have this problem of tons and tons of businesses, so to speak, where there are different risk and rewards, and there has to be a curation of like what makes sense to participate in. And so it introduces a lot of complexity, not only at like the evaluation of like unit economics, but it introduces complexity in terms of like practically speaking, how do you get access to these? And one of the popular ones today is what's called a liquid restaking token. And so you have these vehicles that are quite prominent today, where they are attempting to create access to some of the more popular AVSs. And some of the complexities that are arising aren't just at like the technical level, but it's on like an access level, and like it creates this heterogeneous product that's not always clear to everybody thinking about restaking. And so to like bring like a useful analogy, if you think of like staking as, you know, going to the credit world, you know, treasuries or something, there's very uniform products, a very uniform type of reward being created. And what you're actually seeing play out in this AVS and this restaking landscape is something more akin to corporate or to even junk bonds. And so you enter this really new landscape of like, how do we actually curate an effective product for people looking to participate, because it's not so simple as just getting a staking reward. There is that level, like that's what's actually creating it, but there is some risk really in unpacking it, not just at the unit economic level, but like getting access to some of them. And so that's when you look at like the risks such as like the network creation, like the quality of collateral, and these are some of the things that Adrian was touching on. Like, how are we actually creating this security? Is it with native staked ETH? Is it with some LST like Lido staked ETH, or is it even something else? Are there native tokens of these businesses, some governance tokens that are creating it? And all of these lead to more complex questions to evaluate in terms of like what kind of reward you're getting in exchange for this risk. And then it's compounded, of course, by technical risk. So like actually staking is not that simple. And we're seeing that play out as you compound the layers on top. And so like a good example that we've seen play out in EigenLayer is this proof system. And so you're seeing additional fees compound that's actually making it not even profitable to participate in native staking in this restaking ecosystem. And so it's complexity on top of complexity on top of like actually complex unit economics of young businesses. And so it's really a tough landscape to enter without really a thoughtful framework at each layer, not just at the unit economics, but at the restaking platform layer. EigenLayer versus competition. There are trade-offs. And at the staking layer, there are trade-offs. And then at the actual curator level, who is curating your selection of all of these? All of which deserves thoughtful consideration and how you end up participating in this marketplace. Next slide.
And if I could just jump in real quick before, I just want to make two quick points. One is to double down on the fact that, the way we see this is that this is all an analogy, right? So when we talk about certain securities or whatever, this is an analogy. It's it's helpful to folks to understand the concepts, but like I would argue that when we talk about staking, we're talking about something fundamentally different. That's the first thing. Second thing is in terms of like assessing the risk of these things, I think there's a big question mark there, right? So what we need is clarity on the penalties, and then we can talk about more deeply about what kind of risk are you putting your stake at. So like, if you talk about certain kinds of securities, you say, well, you're taking a huge risk that you go to zero. You know, I wonder, we'll have to wait and see, but we have to actually understand the penalties to understand what kind, because like you look at historical slashing events on Ethereum, for instance, there haven't been a ton. And when you look at them, the penalties are, I'd say in terms of staking, yeah, they can be kind of moderate, but they're not drastic. Like no one's getting wiped out or hasn't been wiped out, I should say. So just kind of putting that into perspective and just kind of doubling down on the opaqueness right now of the risk reward parameters.
And
Yeah,
if
that's
I can
a
just step in. Sorry,
Go ahead.
no, just to agree fully on the point we mentioned earlier in one of the slides, we disclaimed that all of the analogies that we make to the traditional world are for the benefit of somebody who is raised in a TradFi background, but obviously staking is unlike anything we've ever seen before. And so these analogies are very imperfect and limited in their ability to explain things and shouldn't be used or construed as like, oh, this is like a corporate bond. It's like, okay, it's a framework, but it's not actually what it is, and it's not actually what it behaves because it's something completely new. One thing that we think about a lot as contributors to Lido is liquidity, and there was a point that's worth making here that a liquid restaking token has liquid in the name, but we actually expect the liquidity to be less of a feature because we don't actually expect moneyness to be that major of a feature for LRTs going forward. You may be proved wrong. But if the idea of an LRT is to provide heterogeneous exposure to a curated set of AVSs, it's very unlikely that it will have the quality of moneyness that LSTs may have, for example. And in order to manage this liquidity risk of committing restaked capital that may have a delay on withdrawals, it may turn out that actually relying on LSTs to perform native staking will be a source of competitive advantage because it will help abstract away the difficulty of having to natively restake and just focus on the curation activity, which is where the competitive advantage should be sourced from, in our view. Sorry to interrupt. Those were the 2 points that I wanted to make.
No, they're both good points. I mean, and I think it even highlights like another complexity, like the liquidity aspect is so important in DeFi. And like one of the things that's actually causing constraints there is like the size of these AVSs. If you go back to like the unit economics, like there's only so big that this needs to be. And so like how much liquidity, how big can an LRT actually be when it's built upon these really quite small businesses? They don't need to be that big in all scenarios in comparison to like an LST or, Bitcoin as an example, like where are these very large tokens. And so you can generate massive amounts of liquidity because the base is so large. It's really difficult for that to ever exist in this liquid restaking token when it's built in such a heterogeneous way on top of such small businesses. It is much more difficult. So, but this actually leads to go to the next slide, and it actually leads quite well into this, which is our completely invented graph on like how to think about risk in some of these networks. And it is because it's so opaque. As was mentioned, like we have no insight into like the slashing conditions and the actual risk as they're going to play out in these networks, because they're simply unwritten. They simply don't know either. They're still working on building like a usable product that might have some sort of product market fit. And this risk, this restaking trust that's going to exist at some point it's in flux. It's fabricated to an extent. And so our intuition is that at some point there's going to be a level of like correlation. There's going to be an amount of times restaked where you might actually like positively compound some additional rewards, but there's also a chance that you compound negatively. At some point, you may start stacking on bad businesses. And if you like go back up to the slide before, you see there's this curation of AVSs, and not all of these are going to be quality businesses that can successfully pay in the long term. And that's what we really don't know today. And so that's why it's a completely speculative curve in that there may be several. I mean, it may be like venture where it's like 1 in 100, or it could be something much more, but we really don't know. And so to like create this curve of how many times should like $1 be restaked, it's very difficult for us to even like build an intuition other than to like speculatively say like to a degree this could be useful, but also there's a lot of unknown risk. And this is like a very useful way to think about it, is that like you are to an extent compounding the risk each time you restake again and again to multiple services. So let's go to the next slide. One thing that is useful though is to like take a step back and like talk about some things that are interesting. So there's like some practical implementation problems in like LRTs, and there's like inherent risk there. But there's also like some good businesses being built that we didn't talk about really. Like some of them are quite simple to a degree, and like the value creation of these businesses are quite good. And like an obvious one is like pre-confirmations. There's a ton of hype and pre-confirmations and a lot of businesses building in this space. And if we go back to like the Ethereum being the first AVS, I think we could maybe say like Mev Boost was the second AVS. There is a lot of value that's derived from this sidecar, this AVS that exists, and pre-confirmations could, in a similar way, expand this block space market and create a lot of value for just staking in general. It doesn't even necessarily look like LRTs. And so we are excited about businesses that are, minor expansions of like the block space marketplace. And the same could probably be said of like decentralized sequencing. There's some minor expansions of like core utility of like Ethereum and or like rollups. And so the point to make is that there are some sustainable businesses being built. And the key, of course, is to find like sustainable business models. And we prefer those that are very similar to Ethereum, similar to like AVSs we understand well, where it's much easier to quantify the value, much easier to quantify the risk. And as we highlight here, like it's easier to quantify the risk, and it's weird to say that. We're more comfortable with that. There are risks, but we can get comfortable with those risks, whereas the other ones, they're so opaque. Businesses are so new that it's really hard to even like wrap your heads around it. Next slide. Yeah, and then another list of just general risks and problems that is in the restaking space. So because it is so new, you're running into problems of just experimental ideas, experimental software, not just at like the eigenlayer application layer, but also at the AVS layer. And so you end up with this venture-esque type of like risk reward trade-off, which compounds every other level. We already mentioned like the absence of risks in terms of like slashing conditions. That of course compounds it. And then something we touched on a little bit is really like the centralizing effect that this restaking layer is placing on Ethereum, and that there's so many other things to optimize for. Like the practical expedient is to just use like a single operator to make these things work. Whereas like in Ethereum, you may optimize for redundancy, for multiple staking solutions to encourage like moderating risk. And what you're ending up with in this restaking layer is there's so much other complexity and problems that like the practical expedient is to just use a single operator. And so it's creating this centralizing effect on Ethereum in general, which is of course something that we aren't in love with. So I think that is about it, unless there's some other comments from others. Oh, all right, yeah, and a few more things on risk. Yeah, this is actually something that we've thought pretty deeply about as well. And so the duration mismatch is a perfect thing that we're actually seeing playing out in real time. So the AVSs have this inclination to secure security. They want it long term. They want commitments, and you end up with this mismatch in terms of those actually LPs looking to get into this restaking space where they may want flexibility. And so you're getting this mismatch of like capital providers and those that want the capital, or I should say trust providers and those that want the trust. There's a fundamental mismatch that really is an asset liability problem that's playing out in real time, and it's only compounding. There is limited good AVSs, limited good networks to participate in, And there's effectively a fight to get into them. If we want to go back to pre-confirmations and say, look, there's maybe one or two good pre-confirmations, everybody's trying to get into these and nobody's trying to get into the other ones. And so they can demand better terms. And as a restaker, you can end up with this asset liability mismatch. Native token rewards is another good one to touch on. There's inherent risks in doing all of this when you're only being paid in native tokens or points. And so this goes back to the airline miles and the sequence of profits we were thinking through. The whole idea of restaking in general was to find a more economic way to bootstrap your network, to not necessarily inflate your way there. And if we're going back to the same paradigm of using your native tokens to do this, it begs the question, why are we doing this at all? And then how do you, as a restaker, quantify and think about this? Like it's an inherently like complex problem to think through. And then slashing conditions and risk is of course still a problem at every layer. I'll hand it off here, I think. Adrian or Sonia, if there's anything you'd love to add. Otherwise, I think
we're at the end of it. The takeaways is from our report is that we see that Ethereum and proof of stake systems create this notion of collateralized cryptoeconomic security, and restaking extends this paradigm to create a marketplace for decentralized trust. However, restaking is still very much in active development. And at the moment, the large amount of capital that's committed to restaking may find it challenging to load bear the return expectations from the market. But we see a number of promising applications and some mitigations that could be applied in the near term to make this really a thriving ecosystem of new infrastructure solutions. And then finally, we have our return on trust model that Sonia developed, which we decompose as price return work yield, and then the extension restaking yield minus the loss given default. And with that, please clap. Thank you for your time and attention. And I think we're open for questions for the next 10 minutes or so if people have any.
This is awesome, guys. Thank you so much for going through all this. And there's so many things we could dig into here. I think one initial thing I had at kind of a higher level is, we talk about this as being sort of pre-alpha software, kind of unproven business models, unproven businesses even. How would you guys think about when we'll know if restaking is a success, right? Like what kind of criteria and metrics will you want to pay attention to, say once some of these tokens start going live, when some of the rewards are getting paid out? What kind of things should we be measuring or looking at?
So I can take this one first. Actually, Adrian is on the right page pertaining to what I want to touch on, which is Ethereum decentralization. Danny mentioned one of the risks of restaking is a centralizing effect of node operation and restaking platforms. And the analogy that I like to make here is in the pandemic, when something like a 3 Sigma event happened, the world shut down in COVID, we realized that supply chains globally were so optimized for efficiency over time that we lost resilience. We didn't have any, like decentralized sources of supply. A lot of the offshoring activities ended up, pushing supply chains to China or low-cost regions, and that really exposed the weakness in our supply chain. Ethereum, I think, if you look at, building a resilient infrastructure that will be self-regulating, it's so important to think about decentralization that could, provide self-regulating infrastructure without any sort of oversight or reliance on legal constraints or reputational, promise. And one of the things that I like to really emphasize and see as we kind of go out into this restaking realm is the continuous decentralization of Ethereum at the node operator level. And this HHI index, which shows the level of concentration of Ethereum validation by node operator level, is something that I like to track and really fight for. So yes, the message here for me, and I guess I speak for the rest of the chefs, is choose your staking provider wisely. Just don't go for the most kind of reputable node operator, which has, the approval of the SEC. Think about resilience and building decentralized and sustainable systems that are clearly differentiated from just the TradFi, rails that we have built over the last several decades.
Yeah, I'm happy to chime in here too. And I think the obvious one is, of course, fee generation. The whole idea is these are effectively businesses at some point, someday, where they can pay for the price of trust. Absent that, I don't know that you could ever say that this is successful. That is fundamentally something that needs to occur. How do they generate fees? Is it long-term viable? Questions to be answered. But I mean, outside of like fee generating businesses, I don't see how this could be successful in the long term, especially if your job as a restaker or your role in this environment is to collect rewards for lending trust. Ultimately, the rewards have to come from somewhere, and that is, of course, fee generation.
Yeah, that makes sense. And into what Sonia was saying, I think even as a node operator whose name appears on this page, we would love to see further decentralization. We want it to be as easy as possible for folks to run at-home validators. That's kind of why we're all here. That's what makes this industry so exciting.
Can I just double click on that for a sec?
Yeah.
So definitely in agreement. One thing I would say though is that I think almost everything in Web3 and crypto is nuanced. And so what I would say here is that I think decentralization is very important, but I think that there are some folks for which there's a certain kind of service that's required. So you can it's important to decentralize, but I would say that there are some, for instance, institutional token holders that will not use Lido as an example, or other liquid staking protocols, which, as you say, is decentralized on the operator side, which is awesome. And so I think I guess I would encourage folks to think of this as not necessarily an either or. We've got to be maximally solo validators, with fewer operators or something like that. I think it's a balance, and I think that the balance is important. We shouldn't see all staking service providers like Figment running all of Ethereum, obviously. But likewise, if institutional staking service providers went away, I think that we wouldn't maintain the same amount of stake. So I think it's a balancing act a little bit.
Fair enough. I guess final kind of closing thought here. I think for the most part, we've still been talking about restaking AVSs getting built on top of native ETH and liquid staked ETH, different types of LSTs. We're hearing more and more about restaking platforms building on other types of ERC20s, on Bitcoin, even on Solana. How do you think about with all these unknowns that we already have, this kind of extra dimension, right? Do you think that some assets, some tokens are kind of better suited for restaking than others? Do you think that some of these restaking platforms might ultimately end up going after different bases of tokens? Any thoughts there?
Yeah, I mean, it's obviously still very early to say, but I think we can try and address this from a common sense perspective, because there's a lot of complexity and it's easy to get lost in the details. But what struck us is that there's a lot of nuance, and ultimately there's not one size fits all that will be applicable to every user. But from the perspective of an LRT curator, let's imagine for a second that LRTs are the main way that people choose to restake at some point in the future, which seems plausible, because for the same reason that people choose to use staked ETH, it delegates a lot of the complexity to a different layer, and it makes the experience easier. Using Renzo, for example, is easier than having to select individual AVSs to allocate to within EigenLayer. Both are possible, but for the vast majority of users, it's very likely that LRTs will be at the very least, quite large. And so similar to how we thought about this, when you put together an LRT, you're putting together a stack that contains a number of different expectations, both in terms of reward, in terms of your ability to select the right AVSs, but also in terms of the risks. And the biggest risk that we think that a curator can probably affect or modulate is illiquidity and the ability to offer users withdrawal and immediate sort of in and out from an LRT. And in this regard, I think the moneyness of LSTs, ETH is quite money-like as well and has that liquidity, but the moneyness of LSTs that also carry the additional staking reward will probably be more efficient for most users. And then as to like Solana and Bitcoin and all this stuff, and this is a level of intelligence that our small brains can't quite stretch to, unfortunately.
I think I have a quick comment there about, other assets being used as base collateral to secure, other AVSs. If you look at ETH inflation, it's sort of fluctuated between slightly deflationary to, slightly inflationary. And part of it is because ETH is a very sustainable, AVS with its abundant gas fees and actual users. So to use it as the base collateral to secure additional AVSs, it's a very efficient asset. But we don't necessarily have that with other alternative L1 assets just yet. Solana probably is the closest in terms of its inflation being in the single digits, mid single digits. And, it's starting to really gain momentum, from the user base and applications that are being built on top. So I think we're still in the early stages, but I can definitely, in my opinion, see, more assets being embraced by the masses as to become an efficient base collateral for extending to provide, decentralized trust to other networks.
Yeah, makes sense. Chefs, thank you so much for joining us today. Ben, thanks for participating as well. Huge thanks to everybody who tuned in as well. Please go check out Steakhouse's piece. Follow them on Twitter. Any other plugs you guys have, feel free to throw out. Super awesome research coming out of this team, and we're really looking forward to seeing what you guys cook up next. No pun intended. Thanks, y'all.